Hi, my name is Hannah Riley, and this is my partner, Wesley Barkis. We chose to do the financial analysis on the companies Johnson & Johnson and Procter & Gamble. I'm going to be covering Johnson & Johnson.
And I'll be covering Procter & Gamble. To start off, I'm going to go over the shareholders of Procter & Gamble, and Hannah's going to go over the shareholders of Johnson & Johnson. The total shares outstanding for Procter & Gamble are 2,502 million shares. 62.21% of this company is made up of the top 10 institutions. Of these top 10 institutions, the top 3 are Vanguard Group, BlackRock, and State Street.
For Johnson & Johnson, they have the total shares outstanding of 2,682 million, while the top 10 institutions own 69.49%. Their top 3 also are the same as Procter & Gamble, which include Vanguard Group, BlackRock, and State Street. The cost of capital is a measurement of the current long-term cost of funding the firm.
This matters to investors because it allows shareholders to maximize profits while also allowing the company to create value itself. Next, we'll cover our cost of debt financing. The first thing that we have to do is find our cost of debt pre-tax, which is the summation of the default spread and the risk-free rate. For Johnson & Johnson, we found that 3.40% is their pre-tax, and Procter & Gamble is 4.21%. After that, we find the cost of debt after tax.
Johnson & Johnson's cost of debt after tax was equal to 0.3%, whereas Procter & Gamble's cost of debt after tax was equal to 3.18%. For cost of equity financing, we first solved for beta using the regression. The Johnson & Johnson beta we found came out to 0.7829,
while Procter & Gamble's beta came out to 0.5427.
These betas are both below 1, meaning they have less risk than the market. For both companies' overall cost of capital, we had to solve for the weighted average cost of capital. For Johnson & Johnson, their WACC was equal to 6.16%.
And for Procter & Gamble, it was equal to 3.72%. We decided that Procter & Gamble's WACC was better off because it was easier to contrast their revenue at a higher rate. After running the analysis on Procter & Gamble and Johnson & Johnson, we figured out that both companies could increase their value by increasing their debt. After evaluating to see if the firm would benefit from a financial restructuring of the company, we found out that their retained earnings was much heavier than any of their debt. So, both companies could theoretically increase their debt, increasing revenue and growth, which would be a benefit for both companies.
In our case, Johnson & Johnson and Procter & Gamble's debts are both below the optimal levels.
Henceforth, there would be a benefit for both companies to increase their debt. Creating debt is necessary for growth in a company. It gives them capital to acquisition new companies, which creates growth. Johnson & Johnson's main competitors are Pfizer, Novartis, and Merck, which are mostly biotech pharmaceutical companies, while Procter & Gamble's main competition is Unilever and Church & Dwight Company, which make a variety of household products.
To conclude this presentation, we found that both Johnson & Johnson and Procter & Gamble are both currently overvalued in their stock prices right now of $136.35 and $99.28. We found that fairly priced share prices for these companies are $130 for Johnson & Johnson and $95 for Procter & Gamble.
Thank you for watching our video. We hope you enjoyed it.